Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, April 14th, 2017. So this week we had quite a bit of unease and geopolitical tension, and I think this is weighing on stocks. But I still think that this is a normal correction within a bigger uptrend. There are some minor bearish divergences in the advanced decline lines. We'll look at those. There's quite a bit to cover here. We'll look at financials, industrials. We'll look at utilities which are showing actually a bullish divergence. And I think the reason for that is because the investment grade bonds and treasuries have broken out above previous resistance and are at new highs for 2017. The US dollar was under pressure this week, most likely because of the buying of the Japanese yen, which continues to gain on safe haven status. I think the biggest story, of course, was gold, which has broken out above previous resistance. And most importantly, I think the market breadth for gold and gold miners has improved dramatically. And we'll finish off with oil and natural gas. Alright, let's start with S&P 500 ETF SPY, and this is a daily time frame. So you can see that on Thursday, or rather on Wednesday, because this is a Thursday candlestick, there's no trading on Friday because of Good Friday. So on Thursday we see that the candlestick already closed below the 50-day moving average, this line here in red. And on Friday we got another close below it with a rather bearish looking candle. So we have elements of rejection at the top here and also elements of selling pressure because the close was at the low of the day. So this one candlestick is kind of looking similar to this candlestick, also a rather bearish looking. So it looks like this is now confirmed. And it's possible that we will reverse this. It is also possible we will continue lower. Now, after this really big move up, it is a normal thing to have a correction because those who bought down here need to take profits, so they're taking profits. There is a little bit of a bearish divergence here on advanced decline volume line. So you can see here in February, the value was at 79,400, 79.4. Right now it's at 78.7. So it broke below February lows. Notice that the price of the index itself has not broken below February low. So this is a bearish divergence. Whether or not it will play out over, or maybe it will just work itself off, is also possible. Divergences have a notoriety for not working out. So here's another bearish divergence, and this is NYA, New York Stock Exchange Composite. You can see that the index made a clearly higher low, while the advanced decline volume line has broken below February lows. Again, not sure if this will play out. Advanced decline line itself has made a fresh all-time high here, just last week. So, you know, it's kind of difficult to say which one will win out, this bullish divergence or this bearish divergence. So we'll see basically where this goes. Definitely indexes are somewhat still overextended and correction may continue. But again, I think long term we're firmly bullish. S&P 500 on the longer term time frame, my market breadth index still at 5, so this is my proprietary index. In other words, this is firmly bullish posture, and you know, I don't see many issues, I guess, with this index right now, with stocks. Normal pullback here in the percentage of stocks above the 20-50 day. The percentage of stocks above 200 days maintaining quite high at 74% still, and the bullish percent index still at 71%. So still very high readings, consistent with the bull market. Even here in November lows, we're still at 50 for the longer term indicators, and I would start worrying if we get to, let's say, 30s. But right now, I still think we're firmly bullish, basically. Here is S&P 500 on a longer term time frame on the weekly charts. So we had triangle consolidation here, beginning of December, beginning of 2017, breakout, fresh all-time highs. We got stopped here at the yearly pivot point here, resistance 1, and now we're pulling back. I guess a good place to stop would be at a breakout level, which would put it which would put the index somewhere around 2290 or so, 2280. So that's another 2% or so. Here's the Dow Jones Industrial Average. I don't see many issues with this chart. This is still very much a bullish chart. Normal pullback of the all-time highs. Advanced decline lines recently hit all-time highs, and don't see any divergences on the advanced decline lines on Dow Jones. Here's QQQ, the strongest of the bunch, just a monster move here. Rejection-like candle here at all-time highs, now a pullback. But look, we haven't even broken below 50-day moving average. We're still retesting March lows, so we're still very much in a bull mode. All-time highs in the advanced decline lines, and I don't see any bearish divergences in advanced decline lines for QQQ. Here's QQQ with another set of market breadth indicators. Here we do see a little bit of a divergence. This is percentage of stocks above the 200-day and bullish percent index. Notice that it is dropping from very high readings. Used to be 89, now it's 81, while the index itself has not dropped yet below March lows. So this is a little bit of a bearish divergence, and I guess it is playing out. This is IWM, the Russell 2000 small cap index. Notice that we're basically in a trading range starting in December. We attempted to break out here, got stopped and pushed back, but more or less we're still in a trading range for the past 1, 2, 3, 4 months or so. So when we get this breakout, one way or the other, I'm guessing it's going to be a pretty strong move. This one was relatively overextended, so we're basically working off the overbought conditions. Here I thought we had a little bit of bullish divergence actually in March, but I guess it didn't work out and we kind of moved down. But then again, we haven't broken below March lows yet, so I guess we'll see where that goes. Again, IWM. Here is just regular RSI, relative strength index, and notice that it became overbought back in November, December, and since then it just kind of traded sideways. Even notice it's pretty clear divergence. Here we made a higher high in February, but RSI did not. So this was a bearish divergence. But then again, I'm not a big fan of momentum indicator divergences. The market breadth did make a somewhat of a divergence here, because you can see that in December we were at 85 here for percentage of stocks above the 200-day, but now when we broke in March here to fresh all-time highs, notice that the index was at only 77% of stocks above the 200. So there was a little bit of bearish divergence, and I'm guessing it's coming home to roost. Financials are under pressure. There are a lot of banks here, and banks do not like lower interest rates. So maybe this is like a head and shoulders kind of pattern. If this is indeed a head and shoulders, then we can take a look and project the prices down. So this is about 9%, so we could expect a move down of about 9%, so about here. It's also entirely possible that we don't do that and we just kind of stop here, bottom out, and continue higher. Bonds do matter here because these are slightly more interest rate sensitive than other sectors. Here we do have a couple of divergences. You can see the advanced decline is at 78.76, so it is below December lows. So in other words, this is a bearish divergence. Same goes for advanced decline volume line. Now industrials are exhibiting signs of strength, I think, out of the others compared to other sectors. Of course, XLK, the technology, is also very strong, but here's industrials. You can see that we're strongly compared to XLF, for example. XLF, you can see we're already at January lows. The industrials are still not even at March lows. We're still above them. But here we don't have any bearish divergences. Like, you can see that this low here from just yesterday is well above February lows. So I don't see any bearish divergences here in industrials. So I think that industrials could be the beneficiaries of money inflows when finally the markets will find bottom and turn around. This looks like a very strong chart to me. Here's utilities, and this one is more interest rate sensitive than others, dependent on interest rates. So here we have fresh all-time highs in just March, and notice that we're not dropping compared to other ETFs. Notice that we are actually moving somewhat higher. So this is showing that there's strength in utilities, and I think this is because of the bonds, of course. The bonds are moving higher and utilities are moving higher with them. Now utilities are still stuck, so in a true bear market, when everything collapses, utilities will be sold as well. But right now they're, because of the interest rates, because the bonds are moving higher, I think utilities are moving higher together with them. And notice that we now have a bullish divergence with the advanced decline line. So notice that advanced decline line here just a few days ago hit fresh all-time high, and same goes for advanced decline volume. So before fresh all-time highs are put in. So this is showing a bullish divergence, and likely a breakout to fresh all-time highs will follow for utilities. Finally, here are the junk bonds, JNK, symbol JNK. So I still think this is a bullish chart. Junk bonds are correlated highly with the general stock market, so I kind of lump them together. So we had fresh all-time highs, found bottom, surged, throwback, and now we're moved higher. Notice that we're not even remotely close to March lows, as opposed to, let's say, S&P 500, which is already very close to March lows. So junk bonds not as volatile, and actually that's, junk bonds could be used as almost as a stock proxy to a degree because of the higher correlation and lower volatility. And here's junk bonds in the longer term time frame. This is a weekly chart. Also notice that these are all-time highs. This is a adjusted chart, so dividends are this chart is adjusted for dividends. So we're very close to all-time highs, and I think that this is showing a bullish posture for junk bonds. Notice that junk bonds correlate highly to the general market. So to summarize, I think stocks are still in the middle of a corrective pattern. Where it will stop is anybody's guess. March lows is a good place to stop. Here is the January highs is also a good place to stop. But also anything in between and anything very bearish is also possible. But I still think that the longer term is stocks are very much bullish. Okay, let's move on to the investment grade bonds. So here's TLT, the long treasuries. Again, this is a adjusted chart, so it is adjusted for dividends. So looks like we have broken out above previous resistance highs, which happened here in January. These are highs for 2017 and highs since mid-November. Now up here we have an unfilled gap at around 128, 127, 128, together with a 200-day moving average. So this is an obvious resistance target, and we are quite overextended, but TLT has this tendency to spike, and there are pretty strong moves here sometimes that happen in TLT, so it's possible that we'll come up here and just break above them as well. It's kind of difficult still for me to call TLT bullish or bearish, although I am now leaning towards the bullish camp. The reason being is because we had all-time highs just here in July, so here I had no problem. Then we had a big support break and 52-week close, so that is what kind of worries me, is the 52-week close. But it is looking like we're making a series of, well, at least one higher low here, so that's a good start, I guess. And now looks like we're making a higher high as well, so it's possible we'll kind of continue higher. So TLT is more difficult to call than some other bond funds. So let's move on to the one that's easier to call, and that is LQD, which is investment grade corporates. This one looks stronger than TLT, and this was indeed a bear trap. The reason why I say it was a bear trap is because notice that there's this low here at 115.87 from January, which we had a close below it. So some traders like to short on breakdown, and this, you go ahead and short it right there. But looks like this was a bear trap, and the short was immediately, or rather this breakdown was immediately reversed with a gap and a very big white candlestick in mid-March here. And then we just continued higher non-stop basically. So now we did close this gap this week. So this is already a very big achievement for this fund. Basically, since November, we were not able to close this gap. We tried in February but failed, and now again in April here we did close this gap. Also, April, now we're starting to get into a time period where seasonality actually favors bonds versus stocks, sell in May and go away kind of thing. So we're in April and we're getting close to May. So it's possible that we will continue higher for bonds. So here is LQD on the longer term time frame. This one I had less problems with because this looks still like a bullish chart to me. Look, we had here in March 2016, we had a breakout above previous highs, fresh all-time highs, and this is just a normal correction. Yes, it was very sharp and had gaps in it, but we basically bottomed out exactly at previous highs and the previous broken resistance, and then rallied off of resistance, had a throwback, and then another rally, and now we have looks like a breakout above previous resistance, which happened here in February. So this looks like a bullish chart to me, and if we continue having all kinds of international tension, this chart could continue higher actually. At MasterChartsTrading.com we do trade this, and we do longer term kind of trades. We actually opened a position in TLT. I myself opened a position in TLT, and I will show this position in some of the future videos, so that once the trade is complete, I'll show this position. All right, let's move on to the Forex universe. and here's US dollar on the daily time frame. So these are multi-year highs, so in my book this is still a bullish chart. And having said that, looks like we are making series of lower lows and lower highs. Lower low and now possibly a lower high. Because if we continue lower from here and break this March low, this will definitely be a lower high. So we have to be very flexible when we're trading, and I don't want to get married to the idea that we were in a bull market for US dollar. What if I'm wrong? I have to keep an open mind in the sense of maybe we have tapped out here. Maybe this is indeed the multi-year high and we're no longer going to continue higher from here. So we'll be watching this pretty closely, and if we do break this low and continue lower, then maybe we have something to worry about. Right now I still would not short this chart just yet. The reason being is because excuse me, of the longer term. With a longer term time frame, this is a weekly chart of the US dollar. Right now we have a normal, so this is like a breakout from 2015, and now we have a very long consolidation and a breakout to fresh all-time highs, fresh multi-year highs rather. So now we have a pullback to the breakout level. I would start worrying maybe if we break this low from November lows, then we could unravel and continue lower. But for now, I'm still looking at this as a bullish chart. And if I was trading this particular security, it's not possible to trade in the United States except for UUP. You can trade UUP, but it's not an ideal vehicle. I would still trade it on the long side. Here's one of the reasons why the dollar is under pressure, and this is the Japanese yen. So this is reversed US dollar versus Japanese yen. In other words, Japanese yen has been winning this battle since December, and notice that we're now at the 200-day moving average for the Japanese yen. So it's possible we'll break below it, and that's not a good sign if you're a yen bear. A dollar bull. Notice here on the weekly time frame we had a very large move, enormous move. If you listen to my previous videos, I consistently said that we are going to run into resistance around here. Why? The reason is because we have other things happening here, and other things happening was a lot of activity here from 2015-2016. So we ran into the resistance here, and we're now giving it a lot of the surge back. So right now it's possible that this is a falling flag. Maybe eventually we'll find support and break out of this flag. If we do break out of this flag, we can actually take out the highs from 2015, and this will be quite bullish for the dollar. Here's euro on the daily time frame. So these are multi-year lows, but we had a kind of rebound. Here this rebound got stopped at the 200-day moving average and the previous resistance, and you can clearly draw a resistance by looking at the previous low. Here in November we had a breakdown. Here we had an attempt in December to recapture it, we rejected. Again here in February we were attempting to recapture the previous resistance, and again we were rejected. And yet again here in March we were rejected in almost exactly the same level. So this is now a strong resistance. So this is a bearish security. Euro is in a bear market, I think, and if it doesn't, well, it needs to like bottom out here, maybe even a little bit lower here at 1049, and then kind of quickly rally back. If not, we can actually break to fresh multi-year lows very easily. Here it is the same euro versus US dollar in the weekly time frame, and here are those peaks that I was referring to. You can see them more clearly on the weekly time frame. again, this is a bearish security, so fresh multi-year lows are indeed possible. So here's gold on the daily time frame. This is a this week was really big, I think, because I think we had a breakout above previous resistance. And the previous resistance was here in February at 1264. So we now have two closes above, or actually three closes above that previous resistance. I'll show you on the weekly time frame. It looks quite bullish. Here we have gold versus US dollar, and notice that as of late we had a somewhat positive correlation between US dollar and gold. So this is somewhat unusual, and eventually they will uncorrelate. And as I just mentioned with dollar, it's also possible that dollar could have reversed and could continue lower from here. Here's tradable vehicle for the United States retail market, GLD. Notice the same similar breakout, even more bullish looking candles here. Now we're approaching resistance here at 124 from previous November peaks, and this will be actually quite a strong challenge, I think, for gold. Here's gold on the weekly time frame. This is the bullish candlestick I wanted to show. Very bullish looking candlestick. We have elements here of rejection of lower prices and element of buying pressure. In other words, the close was the high was next to the close. So this is a very bullish candlestick on a weekly time frame. So it's very possible we'll continue higher from here for gold. Again, we have major resistance here at 1338. Here it is on the daily time frame from November highs, basically. But here at the interesting point I think I want to show is that this is gold again on the weekly time frame, but going back 5-6 years actually. So here in the lower part here I have my gold breadth index. This is my proprietary market breadth indicator for gold, and it attempts to call whether the market for gold is in a bull or a bear phase. So here in 2012 we have an entry into a bear market. So all of these rallies, you can see where it's labeled breakout, I would have shorted them if I was trading it back then. The reason being is because this was still a bear market rally. Now this rally here in 2016 was different, because notice that gold breadth index actually flipped positive and continued to be quite strong. It was at 4 until July of 2016. Then we had it started to come down, and from October until actually this week we were at 2, so we were barely bullish. So I was quite worried that this new bull market in gold is going to unravel. But looks like this week we have significant improvement in market breadth, and we're now back up to 3. So I am much more confident now that this bull market will continue and gold could continue higher. Where is it gonna go? Nobody knows. And I hate making projections, how high something or how low something will go. But I do know that, notice that the size of this bear market continues significantly lower. So peak to trough here, about 40%. So I don't see why it cannot go up about 40% from the lows. So we could continue to like 1500 just to be evenly matched, so to speak. Here's GDX on the daily time frame. Here I have a bunch of my proprietary indicators again. They have improved. Notice this is a market breadth index for gold, GBI. Another proprietary indicator, it's a percentage of stocks on the buy signal. We're again getting very close to a full-on bullish look here. We need to get above 90 here, and so far we haven't been able to do it since actually October. Notice that we came very close on several occasions, but so far we're not able to get there. Another percentage of stocks in an uptrend. Another indicator also improved. Now 50% of stocks within GDX are in an uptrend, so that's actually a very good sign as well. Here's another one of my proprietary indicators. This is a Breadth Momentum Oscillator, kind of like a MACD of advanced decline line for GDX, also proprietary private data. This one is quite overextended, I think, to the upside. So I think we may see at least a pause to this rally, because we have moved almost 18% of the March low. So we're kind of also, and actually next chart I'll show you what I mean. Here we're coming up on a very strong resistance, and this resistance is formed by several items here. Basically, we have in this area around 2580 or so, we have a lot of activity going on. So first of all, we have the lows from September, and especially here we have a broken support. So with a gap and the big red candlestick. So this is a broken support, a bounce higher, and notice it got rejected exactly at the broken support with a big plunge. Continued lower, and then we had the big rally that started in December and continued into February. So this rally again got stopped exactly at that level. So we're again approaching that level, and we're somewhat overbought. So if we do get there, I think the bears could take advantage of it. Now, that would be the important test, is that how much can the bears take advantage of it. Right now, it looks like we're making higher lows, higher highs relative to this low. So if we continue higher and actually take out these highs, it will be very important and very good sign for GDX and for gold, of course. And here is that same GDX chart in the weekly time frame, and here's that same level I'm referring to, 2580, $26. Basically, we're very close to it, and GDX moves strongly, so we could be there next week actually. Here's briefly West Texas Intermediate, light crude oil. So these are 52-week highs here, but nevertheless, looks like we had a support break here in March of this year, bounced off of it, continued lower. Now we had a breakout above previous lows, so this could be like a W reversal, and we continued higher. We're again running into resistance in this. I think this is a major resistance here in the $53, $55 area, and I think the bears will come out very soon, honestly. Here is the same chart on the weekly time frame. It's not as obvious, but this long 12-week consolidation resolved to the downside. Now we're having a rebound to that exact same area, and I think that the bears are going to at least attempt to push the prices lower. It wouldn't, it just would make sense to at least attempt. Anything is possible. Again, maybe we'll get some geopolitical tension and somehow we get disruptions in oil supplies, but I think the oil is becoming less relevant than it used to be to the economy. Here's natural gas, daily time frame, very volatile, 52-week highs, very deep pullback, and we almost came down to the breakout level, which is marked here on the with a green line. Came down almost to it, but then we rallied off with really strong rally here off of February lows. On the weekly time frame, again, very volatile chart, you can see. So I always recommend that new traders avoid trading it altogether. Anyways, here's resistance that was from previous highs, broke out above resistance, and at this point I would consider it bullish. I already considered it bullish, and I started trading it on the upside only. So, pullback, fresh all-time, fresh 52-week highs, and now I had a really deep pullback here into February and March, and now a rally off of the lows here. So generally speaking, I think this is a bullish chart. I think it will probably continue higher, but we could see we're a little bit overextended after a surge off of February, March. So I think maybe we'll continue, maybe we'll trade sideways a little bit and then surge higher. Anyways, if you like what you're hearing, please like the video. If you have any comments, do comment below, and of course, share this video with others who might benefit from it. Please stay tuned on how to find us on the internet. Thanks for watching and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because preservation of capital is really one of the paramount to the success as trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.